Welcome back, everybody. Today we're going to be starting chapter 3. We're going to get about a third of the way through the material. So we'll be covering about 20 PowerPoint slides today. So just bear with me. So chapter 2, we were analyzing transactions, worked on a trial balance and some journal entries. On chapter 1, we were just going over the accounting equation and how different types of elements affect the accounting equation. So this chapter is going to build a little bit on both those chapters. Obviously, every chapter we have is kind of building on the previous one. So hopefully everyone's understanding what's going on so far in the course. If not, please get with me and let me know what you're struggling with so we can take care of that. I'm still going to post the solutions for homework too. I wanted you all to work through those over the weekend. But don't worry if you feel like you were struggling with those. If you tried and you did hard, you'll get your credit on it. But I will be posting the solutions. I was planning on doing it before it was due, but I wanted to let you all work through it. So don't get frustrated with that. Moving forward, I will be posting them sometimes moving forward so you can see them. But just as long as you try and you're understanding it, then you're all good with homework. So that's that with homework. So let's go ahead and get into chapter 3. Once again, chapter 3 is going to be dealing with the adjusting process. So what exactly does the adjusting process mean? So in accounting, the adjusting process is going to happen at the end of an accounting period. So for example, at the end of a month, at the end of a quarter, or at the end of an annual period, or at the end of the year. So pretty much what they're going to be adjusting is the accruals and deferrals that we'll get to within this chapter. So what are the learning objectives for this chapter? First, we want to describe the nature of the adjusting process. We want to prepare adjusting entries for accruals and for deferrals. We also want to prepare the adjusting entries for depreciation. Summarize the adjusting process. Prepare an adjusted trial balance. So the trial balance is one of the homework problems that we saw from last chapter, so we should be a little familiar with that. We'll touch on it again this chapter to make sure everyone's okay with it. And then describe and illustrate the use of vertical analysis in evaluating a company's performance and financial condition. So first of all, let's just start with the accrual and cash basis of accounting, okay? So in most accounting, like for elements within a business, most businesses are going to operate on the accrual basis of accounting. Most of your large ones, for example, are going to operate on the accrual basis of accounting. It actually measures the transactions of a business and shows the financial position and the strengths and weaknesses of a company much more accurately if we use accrual basis of accounting as opposed to the cash basis of accounting. So what are the differences between accrual basis of accounting and cash basis? So it says here that accrual basis of accounting is going to measure revenues and their related expenses in the period in which the income statement, in the period in which the service has been performed or product has been delivered, okay? So we're more concerned when the transaction takes place is what that's saying, as opposed to when the actual cash is received from that transaction. Because obviously if we're entering into a transaction, then it's to be to make money, right? So they're going to pay us for that transaction. So what the accrual basis is saying, we're more concerned of when we actually have that transaction with the customer as opposed to when that customer is paying us the money. As you can see here, it says cash may not be received from customers during the same period as the transaction. So the accrual basis of accounting requires expenses to be recorded when they are incurred, but not necessarily when cash is paid. And this is a requirement for GAAP, which is once again generally accepted accounting principles. So if you're reporting on any other basis of accounting other than the accrual basis of accounting, then it's not GAAP. There are some different types of accounting basis that is acceptable, but we'll get into that at a much later time. But for now, just know that the accrual basis is measuring the items or the transactions when they occur as opposed to when the cash happens. So now let's talk about the cash basis of accounting. Obviously, if on the cash basis of accounting, the name kind of gives it away. It gives it away. Here we're going to be concerned when the cash is actually switching hands. So it says here revenues and expenses are going to be reported on the income statement in the period in which cash is received or paid. This is going to be used by a lot of individuals and small service businesses just because it's a lot easier for them to keep track of it on the cash basis of accounting. But as I said previously, most large businesses, cash basis is not going to provide an accurate financial statements for the user's needs because they're going to be more concerned about what actually happened in a period and not when the money's coming in or money's going out. So that's the main difference between the cash basis of accounting and the accrual basis. The accrual basis, we're concerned when the transaction took place. The cash basis, we're concerned when the cash changed hands, so when the bills were paid or when the money was received from the bills being paid. So that's the main difference between the two. So let's talk about revenue and expense recognition. So let's just talk about these two terms one more time. These are terms from chapter 1. So remember, revenue and both revenues and expenses are going to be elements that we account for. These elements affect the accounting equation. If you recall, revenues are going to be original credit balances. So revenues are credit balances, and expenses are going to be original debit balances. Okay. So once again, these are income statement elements. These are gonna be entered into your income statement, right? The assets, liabilities, and equities is for your balance sheet. This is the income statement. Remember, income statement measures your revenues and expenses, right? To ultimately give you a net income or net operating loss. So pretty much what we're going to get to now is how do we account for these revenues and expenses? When do we recognize them? Okay, meaning when do we account for them? So under the revenue recognition principle, revenues are recorded when services have been performed or products have been delivered to customers. Okay, so what's that saying? So pretty much revenue recognition. I'm going to recognize revenue. Say if I'm in the service industry, and let's say I'm an electrician, and you call me and you have an issue with your electricity in your house. Say I come in there, I perform all my duties, I do my service, right? And then I bill you for it. So me as the electrician, I'm going to record that as revenue, even though you haven't paid me for my service that I provided for you yet. I've fulfilled all my obligations and all my duties within our contract between the individual and the electrician. So when the electrician goes and performs his service call and performs his service, he is thereby entitled to count that as revenue because he's going to receive that money from the individual at a later point in time if they don't pay. But they're going to go ahead and they're going to count that as revenue, whether the money's in their hand when they leave there, or if the person tells them they're going to pay them at a later date, which would still be an asset. It would just be an account receivable. So that's what the revenue recognition principle is saying. When the services have been performed or products have been delivered to customers, we're counting that as revenue, even though they haven't paid, because we've fulfilled our rights and our duties. So it says here, revenue is normally measured as assets received, such as cash or accounts receivable. Because remember, back to the electrician, if he goes through the service call, he performs a service. The person who called them for the service is either going to pay them in cash, or they're going to say, hey, I'll pay you at a later point in time, in which the electrician would account for an account receivable because they're going to be paid at a later time. Either way, they're recognizing revenue. So the process of recognizing revenues is called revenue recognition. Okay, let's talk about the expense recognition principle. So under this principle, the expenses incurred in generating revenue must be reported in the same period as the related revenue. Okay, this is known as the matching principle. So if we earn a revenue in a certain period, let's say we earned revenue in January, say the electrician earned revenue in January, whatever expense he had to incur in order to fulfill his service call needs to be expensed within the month of January as well. And that makes sense if you think about it, because if he wants to see how much money he made on that service call, then he wants to match his expenses with that job, particularly in that accounting period in January, right? Because he's going to want to know how much money he made on the job and in the month of January. So in order to do that, you need to match your expense against the revenue that it earned to see how profitable it was. What good does it do if we incur an expense, or if we report an expense in the month of February that the revenue was made in January? So January's revenues are going to be overstated because they're not going to be expensed correctly, and the expenses will be understated in one period and the expense will be overstated in another period. So it's going to distort the actual profitability of each month. So pretty much what it's saying here, the same period of revenue is going to be recognized is the same period that we need to recognize an expense. Once again, it's a matching principle. So by matching revenues and expenses, net income or loss for the period is going to be properly reported on the income statement. Once again, remember, we want to match those to see how much we really make off a certain job or in a certain amount of time. The relative revenues and expenses must be reported within that period. Adjusting entries are required to properly match revenues and expenses, okay? So let's talk about the adjusting process, okay? So once again, this is going to happen at the end of the accounting period, right? An unadjusted trial balance is prepared to verify that the total debit balances equal total credit balances. If you recall, this was one of the homework problems that we reviewed in class on Friday. You pretty much just have a list of accounts for the unadjusted trial balance, and you start with your assets, work your way through the elements that appear on the balance sheet, which is assets, liabilities, equities. Then you get into the revenues and expense accounts. Remember, we just punch them in exactly what the elements are, whether they're debits or credits, right? So that's the unadjusted trial balance, and that's going to show us whether we have an error or not, whether our debits are equal to our credits, because if they're not, then there's something wrong. So many of these account balances are going to be reported in the financial statements without change. So what's that mean? So when we prepare that unadjusted trial balance and we have the debits and the credits for the relevant elements, some of those elements are going to be unchanged when we report them on the financial statements. A lot of times land, that's a good example because it's carried at historical cost, okay? Unless we sold it. So if we're still just carrying that land, then that land's going to be unadjusted. So that balance that's reported in the land account is going to be reported in the financial statements without change. However, other ones are going to have to be adjusted to be correctly stated within the financial statements. Okay, it says here, some accounts on the unadjusted trial balance, however, require adjustments for the following reasons. Okay, some expenses are not recorded daily. So an example here, it says the daily use of supplies would require many entries with small amounts. So maybe they're not doing just all the entries of small amounts. Maybe they're going to just do a periodic count. Maybe at the beginning of the month of January, they'll count to see how many expenses they have on hand. And at the end of the month of January, they'll do another physical observance or another physical count of what they have on hand. And then they'll just make one adjusting entry at the end of the month to adjust the expense account and the supplies account. So they'll debit an expense for the amount consumed within the period and then credit supplies to reduce the asset. So that's an example of how expenses are not going to be recorded daily, okay? Some revenues and expenses are incurred as time passes rather than as a separate transaction. So in this case, we're not concerned with individual transactions. We're concerned with the passage of time, right? So what's an example of this? Remember, we've talked about rent received in advance, meaning it's unearned rent, meaning it's a liability. These unearned rents expire and become revenue with the passage of time. So it makes sense. Remember I said in class that say I own an apartment building or an apartment complex and I have a tenant that pays me at the end of December for January's rent. So obviously they paid me in advance. So when I receive that money in December up front, I'm still collecting the cash. So I'll debit cash, it's increasing, and then I'll credit unearned rent, right, or unearned revenue because I haven't earned it. So that's a liability. Now, as the month of January progresses and they use up the month of January that they paid, right? So at the end of January, what I will do as my adjusting process, my adjusting entry, is I want to debit the unearned rent and credit rent revenue, right? Because now we're just merely moving it from reducing the liability and then increasing our revenue. Okay, so that's an example of a passage of time as opposed to a transaction. Then it says here some revenues and expenses may be unrecorded at the end of the accounting period. So an example of this is a company may have provided services to customers that has not billed or recorded at the end of the accounting period. So once again, let's refer back to the example of an electrician. Okay, say he made about 4 or 5 service calls in the month of January. He's keeping a little note of it, right? He just in his little journal. He hasn't recorded anything within the actual financial statements yet, but he's making little notes of every job he does. So at the end of the month, he's going to go in and make his adjusting entry and set up an account receivable and then credit the revenue earned for the services that he provided to customers that he's not billed or recorded at the end of the accounting period. So the analysis and updating of accounts at the end of a period before the financial statements are going to be prepared is called the adjusting process. So once again, we start with the unadjusted trial balance that we did in class on Friday. That was one of the homework assignments. And then from there, we're going to go through and adjust the relevant accounts that need to be adjusted, obviously known as the adjusting process, right? The journal entries that bring the accounts up to date at the end of the accounting period are going to be called adjusting entries. So the accounts that are affected are going to be affected by adjusting entries, okay? It's important to note that all adjusting entries affect at least one income statement account and one balance sheet account, okay? So an adjusting entry will always involve a revenue or an expense account, which is an income statement account. Remember, revenues and expenses are measured on the income statement, and an asset or liability account. Assets or liabilities are balance sheet accounts, okay? So once again, all adjusting entries are going to affect the at least one income statement account and one balance sheet account. So if it's affecting an income statement account, it's going to involve a revenue or an expense. If it's going to affect the balance sheet account, it's going to include an asset or a liability account being affected. So let's look at that. So accounts requiring adjustment. So let's just look through here. I know we have the answers on the bottom here, but let's just talk about them for a minute. Indicate with a yes or no whether or not each of the following accounts normally requires an adjusting entry. Okay, cash, we know that's an asset, right? It's the most liquid asset for a company. So cash is not going to require an adjustment, okay? Cash is what it is, okay? Your balance is what the balance is. Utilities expense. What about utilities expenses, okay? These are going to require an adjustment, okay? Wage expense, same thing. Those are going to require an adjustment because we're usually accruing expenses, remember, in the period in which it matches the revenue. Land. No, land is a fixed asset, okay? And it is a unique fixed asset in the way in which it is carried on the balance sheet because it's carried at historical cost, meaning the price we paid when we purchased it, it stays on the books as that price unless we sell that piece of land or if we would construct on it. Okay? Accounts receivable, yes, they're gonna need to be adjusted at the end of the period because we need to set up an allowance for doubtful accounts that are going to net against accounts receivable, and there could be some collections that we need to adjust as well to account for. Unearned rent, remember this is with the passage of time. Unearned rent is going to require an adjustment because that's the example of I own an apartment complex. Someone pays me rent for the month of January at the end of December. In December, I take their money, correct? So I'll debit cash because I'm receiving an asset, it's going up. I've incurred a liability because I took someone's cash without providing the service of rent for January, so I credit it as an unearned rent, which is liability. Then recall the adjusting process at the end of January. Once I have earned my rent, once they have used that space for the month of January, I then debit unearned rent to reduce the liability. And then I'll credit revenue, right? Because then it's moved from unearned revenue to revenue. So that's a little example exercise of the accounts that are going to be requiring adjustment at the end of the accounting period. So the two general classifications of accounts that are going to require adjustment are going to be accruals and deferrals. So once again, the two general classifications of accounts that require adjustment are going to be accruals and deferrals. Let's talk about accruals for a minute. So we'll start at the top line where it says accrual. So this occurs when revenue has been earned or an expense has been incurred but has not been recorded. So this is just at the point of transacting with the customer or a supplier, whichever whichever it has. So if we're with the customer, then revenue's been earned, or with the supplier, we've incurred an expense, right? But it's not been recorded. So we just know this has happened at this point. Made a little note, a little memorandum. Okay, accrual for revenue. Now this is where we have an adjusting entry. Debit an asset account of accounts receivable, okay? And then credit a revenue account. So at the end of the period when we accrue for the revenue, this is let's revert back to that electrician example. So in the month of January, he did a couple service calls. At that point in time, he hadn't accounted for it within his statements yet or within his journal. So at this point in time, he needs to make an adjusting entry. Okay, so he's going to want a debit accounts receivable and then credit revenue account, and it's going to keep track of the revenue that he earned in the period, even though he hasn't received the money. So he needs to show that he's going to be receiving money from certain individual customers, debit an account receivable, and then he needs to account the revenue that he earned, because remember, he's already fulfilled his duties. Okay, no different than if you work a 9-to-5 job and you get paid bi-weekly. Okay, when you work that pay period, those 2 weeks. Remember, you have a pay period start date and a pay period end date. So maybe you work Monday through Friday, then Monday through Friday. That's your bi-weekly period that you work. You might not get that check on that actual Friday that you finished work on the second week. You might not get paid till the following Monday. But that company still owes you that money, right? And you still want to receive that money. So if you were going to keep a little journal of yourself to make an adjusting entry to account for the revenue the company owes you, then you're going to debit account receivable for the amount that you earn within that pay period. Okay, then you're going to credit revenue if that's how you're accounting for it on the accrual method of accounting. What about the adjusting entry? Debits an expense account, or accrual. I'm sorry, the accrual for an expense. Sorry, this is the next. The first one was revenue. That's an expense. So this is dealing with an expense. The adjusting entry for an expense would be debit an expense account and credit a related liability such as accounts payable or wages payable. So once again, let's assume that we're a company. We have an employer that's working for us while they earn wages during their biweekly pay period, like we were just talking about. If I'm a company, at the end of that pay period, whenever I decide what you've earned, I look at your time clock, or your time card, or based upon where you punch in, punch out, where you time in, time out. I'm going to see how much I owe you. It's going to be based upon an hourly rate times the amount of hours you worked. Okay, so I'm going to go ahead. Let's say it's just $10 for simplicity, and then I'm going to debit an expense for that period, that period that you worked for $10, and then credit wages payable because I haven't paid the employee yet, but I've incurred the expense because I've already realized an expense because they performed their duty, so I owe them. So now I'm just setting it up as an actual wages payable, which is a liability. So once again, accrual for revenue, debit accounts receivable, credit the revenue account, accrue for expenses. We go ahead and realize the expense and set up the payable account. Okay. Let's talk a little more about accruals. Let's talk about accrued revenue. Okay. Let's look up here at the top left-hand corner of this chart. So it says the initial recording, the transaction revenue has been earned. Okay, once again, let's talk about that electrician. So he's performed his service call and he's fixed their electricity issues. So the revenue's been earned, okay? At this point, no journal entry has been made, remember? So now let's say at the end of the month of January, he did a certain amount of service calls. He's already earned it, but made no journal entry. So he's performed the work, right? He's performed those service calls, went to their house and fixed their issues. Now at the end of January, he needs to keep track of what he's earned, right? And what people owe him. So what his adjusting entry is going to be is he's going to debit accounts receivable because that's an asset. That's the right to receive money from the people that he did the service calls for, right? Because they owe him on account. So he's going to debit accounts receivable to keep track of the receivable from those customers, which is an asset. That's why we're debiting it. It's increasing. Then we're going to credit the revenue account because we're counting it as revenue, right? The period in which it's earned, that's what we're counting as revenue. Revenue is a credit balance, right? It's an original credit, okay? What financial statements is this journal entry affecting? Accounts receivable, it's an asset. So if it's an asset, it's going to be a balance sheet account. It's increasing. Debit the asset. What about revenue? Revenue is an income statement account, okay? So that's increasing. That's an income statement. Let's talk about accrued expenses, okay? The initial recording of it. The transaction, the expense has been incurred, okay? So in this case, let's say that we are receiving supplies from a supplier, right? And we are going to pay them on account. So we have an account set up with them. They lend us a line of credit because we're faithful to pay our bills. So they've sent us $1,000 worth of supplies during the month of January. So at that point, the expense has been incurred, no journal entry has been made. Okay, now at the end of the accounting period, however, I don't owe them until the month of February. So I need to account for the fact that I've incurred an expense and then in the accounts payable, okay? Well, I use a bad one. I said supplies. So let's assume that they provided a service instead. So we're on the other end of the service. So ignore the supplies because that would be an asset account. I'm sorry, we're accruing expense. So let's say now that we're the customer, right? Our company has an electrical issue for this one. So I apologize for the accrued expense. So we're the customer, we're a company, we're having electrical issues. So now we call an electrician during the month of January to come and fix something for us, right? Well, now we're going to just say, okay, we're going to pay you later for your service that you provided of fixing our electrical issues. So now at the end of the month, we need to say, okay, well, we've incurred an expense because we've had to get our electricity fixed in our building. So we want to debit the expense account. Okay, this is an income statement item. It's an expense. Expenses are debits. We want to increase the expense account. So we debit the expense for the amount that he charged us for the service that he provided for fixing our electricity in January. Then we haven't paid him yet, so we want to set up an accounts payable, which is incurring a liability. This is a balance sheet account. It's increasing. Remember, accounts payable is a liability. Liabilities are credit balances, so we want to increase it, credit it. Once again, we've incurred an expense and debit it to increase it. Affects your income statement. Then we want to credit accounts payable because we're going to pay them at a later date. Okay, so once again, that's increasing our liabilities. Balance sheet account. Okay, let's talk a little bit about deferrals, okay? A deferral occurs when cash related to a future revenue or expense has been initially recorded as a liability or as an asset, okay? So let's look at the unearned revenue, okay? This is the same example that we had talked about previously if I own an apartment complex, right? And someone pays me in advance, okay? So this is what this bullet's talking about here, unearned revenue. Initially recorded as a liability if the cash received is related to a future revenue. So let's talk about that bullet point. Once again, remember, I own an apartment complex, right? Someone pays me at the end of December for rent that's going to take place in January. So they're paying the landlord in advance. At the end of December, you're paying $100 to rent your apartment complex or your unit for the month of January. At that point, I debit cash, credit unearned revenue account, okay? So that's the entry where we're at right now because I received the cash, but I haven't earned it. So I debit cash, credit unearned revenue. The unearned revenue is a liability. Okay, now we're gonna assume we've earned the revenue, right? So adjusting entry in the period when the revenue is earned. So now we're gonna fast forward to the end of January, right? Because recall right here they paid us money at the end of December. They paid us $100 at the end of December for the right to use our asset in January. So at that point, we received the cash, hadn't fulfilled our service, so we had to set up a liability. Now we're at the end of January, so our tenant has actually used up our space for the period in which they paid. So we've actually earned that. We don't owe them anything, so we have actually satisfied our liability. So at the end of January, what we need to make our adjusting entry, we need to debit the original liability account of our unearned revenue account. We debit it because we want to decrease it. Remember, unearned revenue is a liability. It's a credit balance. So in order to reduce the credit balance, we want to debit it. So we debit the unearned revenue because we've earned it now, and then credit the revenue account for the same entry, same amount. Okay. Once again, we've reduced our liability because we've actually earned the revenue now because the tenant has been fulfilled or spent the month of January within our space. And so we're going to reduce our liability of unearned revenue, then we're going to increase our revenue. Because remember, revenue is an original credit account. Okay? This affects your balance sheet, reduces your liabilities on the balance sheet. This increases your revenues on the income statement. Okay? Now let's talk about prepaid expenses, okay? Once again, this is talking about the initial recording of it, okay? Initially recorded as an asset if the cash is paid and related to a future expense. Okay, so now we've paid money out and it's related to a future expense. Okay, so let's talk about that. The prepaid expenses. In class, remember, I used the example about buying a Super Bowl ticket. So if you buy that Super Bowl ticket in advance, right, then that's going to be a prepaid expense, right? Because you've paid cash for that ticket for the right to attend the game, but you haven't actually fulfilled that right. You haven't went to the game yet, right? So whoever sold you that ticket has a liability to you because they took your money and then they gave you a ticket, right? But they still owe you for the right to go to that game. So when we initially pay the right to go to that Super Bowl, right, when they give us the ticket, so when we pay that money to go to the Super Bowl, we're going to debit the prepaid expense account, right? Because that's an asset to us. Because we know that's the ticket. That's the value of that ticket is a prepaid expense, what you pay for the ticket, right? And then obviously we're going to credit cash at that point because we've paid, right? We've paid cash out. Cash is an original debit, so we're going to credit it. So that's the point when we established a prepaid expense. So we've paid for the right to go to the Super Bowl, but we haven't went yet. So they owe us that right. So if they owe us that, then that means we've had an asset. So we debit prepaid expense, credit cash. That's where we are right here at the initial recording. Now we're going to assume that we've already used up the right to go to the Super Bowl at this, right? So adjusting entry in the period in which the expense is incurred. So if we've incurred the expense of the ticket, that means that we've actually went to the game. We've used the right of that ticket up, right? So at that point, then we want to actually realize an expense, right? Remember, expenses are debit entries, so we're going to debit an expense account, right? Because we've actually incurred the expense of the ticket now. And then credit the prepaid expense account. Because remember, we were holding it here as an asset to say, okay, hey, you all owe us the right to go to the game. So now they don't owe us the right anymore, so we have to reduce that right. We know prepaid expense is an asset, right? So if it's original debit to increase it, to decrease that prepaid expense account, then we need to credit it. We also have to incur the expense. So that's a little bit on the deferrals, okay, on the unearned revenue and the prepaid expense. Okay, so let's talk about the deferrals here. We can see here, we'll start with unearned revenue right here. The initial recording, transaction, cash has been received. Revenue that will be earned in a future period. So what's the initial recording? So once again, let's just say here, this is, I'm a landlord. Someone paid me cash at the end of December again, remember, for the month of January rent. So at that point, at the end of December, I'm going to take the tenant's cash that they're paying me in advance for the month of January. So in December, I'm going to debit cash and credit unearned revenue. Remember, at this point, the tenant has paid me at the end of December for the right to use my asset in January. So at the end of December, I'm taking their money, debiting cash. It's an asset. It's increasing, so we're debiting it. But we also owe them the month of January's space. So that we've incurred a liability to that tenant. So the credit side of that entry is going to be unearned revenue, which is the liability. Okay, both of these are balance sheet accounts. Cash is an asset, it's increasing. Liabilities are increasing, both balance sheet accounts. Okay. At the end of the accounting period, so now this is the end of January, right? So now she's used up what she paid for, right? She used up my apartment complex space for the month of January. So at that point, revenue has been earned, right? So I need to now I have to say, okay, I no longer owe them anything because they've already used up what they paid me for. So at this point, revenue has been earned. So at the end of January, my adjusting entry will be to debit unearned revenue because we originally credited it here. So if we increased unearned revenue, the liability, we've satisfied our liability, so we have to debit it over here. So this reduces our liability. And now we've earned money. We've earned the cash they paid us. So we want to reduce the liability of unearned revenue and then give ourselves credit for the revenue that we've earned. Because remember, revenues are credits, original credits. Okay? This reduces a balance sheet account of a liability of unearned revenue. This is an income statement account. It increases the revenue, right? Notice how I'm saying it's good. The adjusting entries is going to affect a balance sheet count and an income statement account. Well, here's an example of how that's so. Remember this liability, we've satisfied it. It's reducing it by debiting it on the balance sheet. This is an income statement account. we need to increase the revenue because now we have actually satisfied the right of earning. The revenue's been earned because the tenant has utilized that space for the month of January that they paid for in December. Okay, next, prepaid expense. What about the initial recording of a prepaid expense? So once again, cash has been paid for a future expense. So once again, let's revert back to that Super Bowl example. So we paid for a Super Bowl ticket at the end of January. The Super Bowl's in February. So obviously we now have an asset, right? We've not actually went to the game, but we paid cash to go. So the way we keep track of saying, okay, well, you owe us something, right? But we've paid you money. So we'll debit prepaid expense. That's our right to go to the game. That's our ticket, for example, right? That's our prepaid expense of a ticket to go to the Super Bowl. And obviously, in order to get that prepaid expense, we have to use up some cash, right? So prepaid expense is an asset because that ticket to go to the game is an asset until the game has happened, until you've went, right? So that's the prepaid expense there. And that's the cash you paid for that asset of the ticket. So when you pay the money, obviously cash is an asset. It's a debit balance. So when you pay a ticket, pay Ticket Hub or Ticketmaster for the ticket, cash is going out of the business or out of your hands. So it's going to credit it to reduce it. And then we have to keep track that we have a prepaid expense of that ticket. So they owe us, right? So cash has been paid for a future expense. We paid the money for a Super Bowl ticket to go watch the game at a later point in time. So now what about after we've watched the game? After now we've went to the Super Bowl. Okay, your team's either won or lost, but you've went to the game, you had a good time, whatever, maybe you had a bad time, whatever it might be. So now you've actually went to the game. So you've paid the money here to go to the game, and now you actually went to the game. So prepaid expense has been used to generate revenue, okay? So in this case, now we want to debit an expense, right, for the amount that we actually paid. Remember, it was a prepaid expense. Now it's been used to generate revenue, okay? So we've prepaid the expense. So now we need to actually realize the expense and then reduce the prepaid expense, okay? Once again, an expense account. This is going to be an income statement. We're increasing it. So we want to increase the expense at the end of the period. So expenses are debit balances. That's why we're debiting the expense account. Then we have to reduce our asset of a prepaid expense, okay? Because we increased it here, okay? So that's deferrals. Let's talk about some more types of adjustments, okay? Once again, I know we have the answers down here, but classify the following items as prepaid expenses, unearned revenues, accrued expense, or accrued revenue. So wages owed, but not yet paid. Okay, so for part A, wages owed but not yet paid. So what do we think that means here? So that means, let's say someone comes in, or someone comes in the workforce. So we have employees of employees of our business. I'm sorry, they work a week, right? And they don't get paid till they work Monday through Friday. Okay, say the 5th through the 10th, but they don't get paid till the 15th, right? So we owe those customers money for what they've earned through from the 5th through the 10th, right? So the way we're going to account for that as a company is we're going to accrue an expense, right? So we'll debit our expense account to increase our expenses. Then we have to credit wages payable. So we've in effect accrued an expense right here because the employees have earned their money, but they haven't been paid a check yet. So the company that owes them that money, the employer, has to accrue an expense until they pay that employee. What about supplies on hand? Okay, supplies on hand, that'll be a prepaid, right? So if we have supplies on hand, that means we have the supplies, right? And we've prepaid for them. What about fees received but not yet earned? Okay. So once again, let's assume that we are a landlord, right? And a tenant pays us in advance. Remember, for the month of January, they pay us money at the end of December, right? For the right to use something for the month of January. So in December, we receive the tenant's fees, but we haven't earned them yet because they haven't utilized that space for the month of January yet. So at that point, we need to recognize unearned revenue, okay? What about fees earned but not yet received? So in this case, let's put ourselves in the shoes of being the electrician again. So remember, during the month of January, he does these service calls. He provides his service, right? So he's earned those fees, but he's not been paid for them yet, because remember, they're going to pay him in February. So at the end of January, that electrician needs to accrue the revenue that he earned but has not yet received yet. Okay? Okay, once again, this should look familiar. This is the unadjusted trial balance for Net Solutions. I know that the numbers are a little different, I believe, than what we were doing the other day in class. So let's look here. So once again, unadjusted trial balance. Remember, very simple. We just have the list of accounts, right? The accounts will be given to us. Then we just have the debit balance and the credit balance, right? And this is the account number. This is just from the chart of accounts. So for example, cash, that account number is 11 in the chart of accounts. So accounts receivable, that's a 12, so on and so forth. So that's all the account number is talking about here. Oh, sorry. That's all the account number is right here, okay? So once again, we just want to punch in each relevant element, right? Plug in each element starting with assets. So if you can see here, cash, accounts receivable, supplies, prepaid insurance, land, office equipment, all of these are assets, right? They're all debit balances, because remember, assets are original debit balances, okay? Notice one thing too, they're listed in the order of liquidity. Cash is most liquid, followed by accounts receivable, supplies. Remember, liquidity, how fast can you convert an asset to cash? So obviously cash is most liquid because that's in itself what it is. Accounts receivable, those are going to be the second most liquid because that's already happened. That's going to be money you're going to be receiving throughout the month from your trade receivables. So once again, you start with assets, list them in the order of liquidity. Those are all debit balances. Next, we have liabilities. Remember, accounts payable, unearned rent, those are the two components of liabilities now. Those are credits, right? Next, we have equity. The capital and the drawing. The capital is the credit, the drawing is a debit balance, remember? And we have fees earned, which is a credit balance. These are income statement accounts now. So all these are balance sheet accounts. Assets, liabilities, equity. So you start with your balance sheet. Then you move on to your income statement for your unadjusted trial balance, okay? You can see fees earned, that's the top of your income statement. That's your revenues. Then you have your relative expenses, which is going to be debits, right? Because expenses are debits. So once again, this is why you need to know the elements, i.e. cash, liabilities, equities, revenues, expenses. You need to know whether they're debit balances or credit balances. Because really, once you know that, the unadjusted trial balance is pretty simple. You just take the accounts that are given to you, plug them in their relative balances. And sometimes there might be an unknown, like the cash was unknown. That's the other problem, but if it is, then your debits and credits should balance. If there's an unknown, the difference is going to be your plug, okay? So that's, once again, that's the unadjusted trial balance. And remember, this is what we look at to see if our debits equal credits. This is what we're going to use at the end of the closing a period, right? So based upon this sheet right here, this is unadjusted trial balance. This is where we're going to make our adjusting entries based upon what this shows us right here, okay? That's why that's very important. Okay, this is just the expanded chart of accounts for Net Solutions. Recall, the chart of accounts is just a listing. It's the organization of the accounts that a company uses to account for transactions. So once again, you can see your balance sheet accounts. These are assets, right? Liabilities, owner's equities. So here, the pink ones are the ones that are the newer ones that we're adding to the chart of accounts. Accumulated depreciation, office equipment. Notice this is right below office equipment. Okay, we're going to get to this concept in a little bit. Just know that for now, this is a contra account, so it's going to be carried right underneath this contra, meaning this reduces the carrying amount of this, and we'll get to that later. For now, I just want to point out that the accumulated depreciation for office equipment is going to be a contra account to the office equipment here. Liabilities. This is going to be just another liabilities account, right? So this is just another component of liabilities, so just original credit balance. Nothing new on equity here. Revenues, we know fees earned, okay. Now this is another component of revenue, right? So rent revenue, this is just another way that the business is making revenue. So just another component. So here is two components of the element of revenue. Notice revenues, expenses are income statement accounts. Once again, your balance sheet accounts, assets, liabilities, equities. Now expenses, once again, these are just two more components out of these components right here of the element of expenses. We've just added insurance expense, depreciation expense. Okay. So accrued revenues, let's talk here. Assume that Net Solutions signed an agreement with Danker Company on December 15th to provide services at a rate of $20 per hour, okay? Now, as of December 31st, Net Solutions had provided 25 hours of services. The revenue will be billed on January 15th, okay? So at the end of this period, remember, Danker Company, he's provided services at a rate of 20 per hour, right? I'm sorry, they're going to provide services to Danker Company. So as of December 31st, Net Solutions provided 25 hours of service, right? At a rate of $20 per hour, okay? So 25 times 20 is $500, okay? So now we know that they provided this service, right? For Net Solutions provided this service for Danker Company, but Danker has yet to pay for the services that Net Solution provided. So at December 31st, which if you notice here, December 31st is the end of an accounting period, the end of a year, right? The last day of the calendar year. So we need to make an adjusting entry. This is the last day of the reporting period, last day of the month, last day of the year. So we need to account for the revenues that Net Solutions earned, right? To be able to truly depict the performance of the company of that month and during that year. So how do we do that? Once again, we need to make an adjusting journal entry to account for the fees earned. Remember, they haven't paid us yet, but we've already satisfied we've already satisfied that service. We've already provided that service, so we're going to count it as revenue. But they haven't paid us, so on December 31st, we're going to debit accounts receivable for $500, right? Because 25 times 20, that's the amount of hours that we've already provided service for in the month of January. But they haven't paid us, so we're receiving an asset of accounts receivable for this right now, right? So accounts receivable, $500, credit fees earned of $500, right? So now this shows that Danker Company owes us for the 25 hours of service at a rate of $20 per hour of $500. So they owe us that. We took note. It's going to be reflective in the statements that that's our position. That's a balance sheet account. It's an asset. It's going up. Sorry. Fees earned, remember this is income statement account. We're accounting for the fees earned, even though the money's not, remember we're accruing, the money's not touched our hands yet. They haven't paid us, but we fulfilled the right to have a right to that money. So we've earned the fees. So we're debiting accounts receivable, crediting fees earned. Remember, fees earned, income statement account. It's a credit balance. It's growing, right? Assets increasing of accounts receivable, what they owe us. Fees earned is increasing, okay? So we've already counted that as money, as revenue, even though we don't have the money in hand yet. So what about the accounting equation impact? Once again, assets, obviously accounts receivable is an asset. It's increasing by $500 because we debited it. Remember, debit an asset, it increases the balance. So it's increasing by $500. So assets have increased, in particular, the component of accounts receivable by $500. Obviously, if we've earned revenue, remember there's a direct relationship between revenues, expenses, and the equity of a company, right? So if we have made money, if we've increased our money here, fees earned, then obviously owner's equity is also going to increase, right? Okay, now let's just talk about some effects that would happen if we do not make that adjusting entry at the end of December, right? So once again, we're talking about this right here. So if Net Solutions did not make this adjusting entry to accrue for revenues, right? What's the impact on the financial statements if we omit this entry? So if we forget to do this entry right here, what's going to be the impact on the financial statements? Let's look here. Remember, it's for $500, right? We're saying they owe us $500, the accounts receivable, and we've counted it as revenue, saying we've earned that money at $500. So let's look at the results of how how this will help show how it impacts the accounting equation as well. So let's just see if we just omit that one entry, how much of an impact that's going to have on every component of the business. So once again, effects of omitting the adjusting entry for accrued revenue. So once again, we forget to accrue a revenue that a company actually earned, okay? So that if the adjustment for the accrued revenue of $500, once again, that's this account right here, this transaction we just went through. If the adjustment for the accrued revenue of $500 is not recorded, the income statement and balance sheet prepared on December 31st will be misstated, okay? So but notice the effects, it's pervasive. It's going to affect the income statement and balance sheet, okay? So both statements are going to be affected. So how is that so? Just by that one entry. Let's look at the income statement first. Remember, revenues is what we would be accounting for. We'd be accruing a revenue. So if we did not accrue the revenue, revenues would be understated by $500, right? Because we know this entry right here, when we credit fees earned of $500, that is increasing the revenue line item on your income statement. So if we omit that entry, revenues will be understated by $500. That's what's in parentheses, okay? Expenses are correctly stated, so no effect there, right? So expenses are correct, but revenues are understated. So if revenues are understated by $500, then net income is going to be understated by $500, right? It just carries directly down, which makes sense, right? If we understate the revenues by $500, then net income is understated by $500, even if expenses are correctly stated. Okay, so there's our income statement. That's how the income statement is going to be misstated. Now, how does that affect the balance sheet? So let's look here. Our net income, remember? Now let's start with here. Let's start with revenues. So if revenues are understated by 500, right? Then our assets are going to be understated by 500. Okay, because remember, here's our asset, right? When we said, okay, you owe us $500 because we provided the service, but you haven't paid us, that's an asset, right? So when we debit the accounts receivable, that's increasing at 500. If we omit it, assets are also going to be understated. So that's why these are tied together here, right? That's the journal entry we made, right? So there's the plug of the journal entry. When we make the debit for accounts receivable, that's increasing assets, the line item on the balance sheet by 500. So to omit it, it'd be understated by 500. When we credited fees earned of 500, that's increasing the line item for revenues on the income statement. So to omit it, it would be understated by 500. So that's how their assets and revenues are understated. If your revenues are understated, it's going to throw your net income down by the same amount, 500. Remember, net income is closed to owner's equity, or net income is closed to retained earnings, which is a component of owner's equity. So we'll just say here, net income closed to equity. So if net income is understated by $500, owner's equity is going to be understated by $500. So once again, these are the effect directly. This is the direct effect of omitting one little accrued revenue. So you can see the impact. It becomes pretty pervasive pretty quickly when you make errors in the accounting system. It affects it all over the place. So once again, this is the journal entry we made. Remember, we debited accounts receivable in the previous entry. We credited revenues. Once again, there it is. Debited accounts receivable. Credit fees earned, right? Revenues. Once again, that would have increased it, but we omitted it here, so it's understated. If revenues are understated, net income is understated. Net income closes the equity, so if net income is understated, equity is understated. So there's the effects of omitting the adjusting entry for accrued revenues. And when I say pervasive on this in accounting, that means it's going to affect more than one statement. So once we can see here, it affects both statements, okay? Okay, so example exercise, adjustment for accrued revenues. At the end of the current year, $13,680 of fees have been earned but have not been billed to clients. Journalize the adjusting entry to record the accrued fees, okay? So obviously it says here at the end of the current year, The fees have been earned of $13,680. So if the fees have earned but have not been billed to clients, so we need to account for that. So if we've earned the fees but we haven't billed them, so obviously if we haven't billed them, then they haven't paid us. So we need to set up account receivable debit of $13,680, and then credit fees earned of $13,680. And once again, this is accrued fees, right? Accrued fees earned, so accrued revenues. Okay, and this is going to be my stopping point for today. Be on the lookout. I'm going to be getting the homework and the quiz for chapter 3 up. You'll have plenty of time to do it. I don't really expect anyone to attempt it until we get through the material the rest of the week. At least I hope that no one attempts it before then. But if you want to, feel free. But I would suggest to wait till we finish through the material. So there's about a third of the way through this chapter. Once again, this stuff does build. So if you're still having problems from chapters 1 or chapter 2, please give me a shout. I will be posting the homework solutions today as well, and going through and grading some homeworks this week from chapters 1 and 2. So just be on the lookout for that as well. I hope this makes sense to everybody. Once again, this is like the first third of the chapter for chapter 3, dealing with adjusting entries. I hope everyone has a good day, and once again I apologize for not being in the class today. Hopefully we'll be back in class on Wednesday. I'll keep you posted with that. So once again, if you need help with anything, please give me a shout. I'll be more than happy to help you, and be on the lookout for the homework and for the quiz coming up. Thank you for your time.